This episode of From Angel to Exit is brought to you by Dash. Dash offers remote knowledge workers to streamline workflows for U.S. businesses. Services include CRM management, email organization, social media content, bookkeeping, research, lead generation, and more. Dash professionals save clients time by managing routine tasks, allowing businesses to focus on growth and other high-value activities. For more information, visit hirewithdash.com. Are you serious about planning a successful business exit? From Angel to Exit is your go-to resource. Subscribe to our newsletter at eckfeldt.com/podcast for even more valuable insights. And to get personalized guidance, take our free exit readiness assessment. It's just 24 questions, and it will give you a clear picture of your exit readiness. Find the assessment at eckfeldt.com/exit. Submit your results, and we'll schedule a free follow-up call to discuss your specific situation and the best way to maximize your valuation and ensure a successful transaction. Now, back to the episode. Welcome, everyone. This is From Angel to Exit. I'm Bruce Eckfeldt. I'm your host. Our guest today is Robert Heil. He is CEO at Financial Aid Services. He's been involved in many EdTech companies, both on kind of various sides of the equation in terms of scaling and exiting companies. I'm excited for this. Robert has some really interesting perspectives, having been involved in different kinds of transactions, and like I said, on different sides of the kind of table on this, has some interesting perspectives and insights. So excited for the conversation, excited to hear his take, and hopefully some good takeaways for founders that are earlier in the process, a couple of insights, maybe a couple of stories that could be interesting. So with all that, Robert, welcome to the program.
Thank you, Bruce. It's good to be here. Thanks for having me on.
Yeah, thanks for being here. Before we kind of get into what you're doing today and kind of getting into kind of deals and what you've learned, we'd love to just kind of get backstory. How did you, I guess, how did you get into business, education, training, and then we can cover a little bit of the transactions that you've been in professionally.
Sure. My background, I've been a part of a lot of different EdTech and consulting firms within the higher education space. Would have never imagined my career would have gone into the higher education space. I was supposed to go to law school, and I was just killing a little bit of time before law school started, and had a unique opportunity to work for an executive vice president at my alma mater, who was a former Wall Street investment banker, and the amount of information that I was learning from him was just terrific. Yeah. And so here I am 30-something years later. Never made it to law school, got pulled into higher education, but it's been very meaningful work to be able to apply some business acumen into mission-driven organizations that are making an impact on the next generation of leaders that graduate from college. So a little bit of an accidental turn, but really glad it worked out the way it did.
Yeah, I'm curious. I started as an architect, then got into technology, and so I got a similar kind of right turn at some point professionally. What training? I guess what about your training as a lawyer have you been able to kind of apply? I guess is it given you a perspective or a set of tools or a way of thinking that you think has helped you as you've kind of got into more of the business world?
Yeah, like I said, I never made it to law school, so there's no training there. The very beginning of my career was had a political background to it. I ran political campaigns, okay. So that's kind of where I cut my teeth, and I learned data through polling and predictive modeling, marketing, PR. Is a tremendous element to political campaigns. So that's really where I cut my teeth. And it was a high pressure environment, but it was a great incubator for learning. So I kind of felt like 1 year in that environment was sometimes the equivalent of 4 years somewhere else.
Pressure cooker.
So it was a good environment to cut my teeth. And that became a nice, jumping pad to, the world of higher education, especially with EdTech and consulting firms.
Yeah. When do you feel like you kind of made the switch, right? Like you realized that you were on a different path, and when did you feel like, I kind of know what path I'm on here, and I know what I'm going to be doing, and there was kind of this thread for you in terms of professional kind of focus?
Yeah, I don't know the exact year moment. It was probably somewhere late 90s, early 2000s. Yeah. Higher education faces some really steep headwinds. It's a challenging industry. And I am drawn to two things, mission-driven work that has big challenge to it. I'm just drawn to that like a magnet. And after a few years in higher education, I found this is where that is. Because running a college or university, it's got every facet of running a business.
Yep.
You're running a school. And in most cases, you're running a small city for thousands of faculty, staff, and students that often live on campus. And you got to provide food and housing. So I don't know of any other industry that combines all three of those: business, schooling, and really running a small city.
Yeah.
So that's why higher education faces a lot of headwinds. That's why it's incredibly challenging. It may seem daunting to some. I like that. So it was this mixture, Bruce, of the challenge that came from that, as well as some really meaningful work that happens in higher education. I knew I had found a space that I could really dedicate my career to.
Yeah. So tell us about kind of the initial kind of entry into the space. What was the organization, or how did you kind of get started in this area?
Yeah, the first decade of my career was spent on a college campus for that executive vice president that I worked for. He put me on a management rotation to where I would spend a few months in, the marketing side of the university. And then he'd rotate me to maybe the admissions and enrollment management, and then to the financial area of the campus. And so over the course of about 18 to 24 months, I got exposure to just about every major entity on a university campus.
Yeah.
And I didn't quite know where he was going with this, but then all of a sudden he started putting me in charge of these major divisions and departments. And I'd be the first to say these were stretch opportunities for me.
Yeah.
I probably didn't have any business running some of these departments that were that big at a pretty early age in my career, but he was a mentor that believed in me, gave me those stretch opportunities. I'm incredibly grateful to him for doing all of that. And things really, fortunately, kind of took off from there.
Yeah. I'm curious, given that kind of rotation model, and I know many companies, usually larger companies that kind of have the departments and the kind of different business units and kind of the resources to be able to develop managers that way. I think it's fascinating kind of to learn what people kind of learn in terms of, as they go to these different departments, what they see as common and what they see as different. Like I'm curious what threads you saw, what commonalities you saw across these departments, and then where you saw contrast.
Yeah, the contrast, I think, was universities can often be very, very siloed to where, this department, probably no different than any business. That stood out to me really early on, and I saw the power of being able to activate all these departments around common goals, departments that would understand how their goals impact this department on the opposite end of campus. That immediately stood out to me as opportunities or ways that those challenges could be converted into opportunities. But yeah, every department, every division does a lot of good things that you learn from. They also have a lot of opportunities to make gains. And so, 5 or 6 months with one area helped sharpen my thinking to go to the next area, because you could learn from the good things you saw as well as the weaknesses. And that just made you a better thinker, for the next 4 months that I spent somewhere else.
Yeah. And so as you got into more of the EdTech side of things, I always find it interesting with these kind of spaces where you've got so much sort of complications with, government and nonprofits and mission driven and regulatory environments. And then you've got, commercial ventures inside the space. Like when did you first kind of get onto the commercial kind of EdTech side of things?
Yeah, that was somewhere around 2007, 2008. I had the opportunity to kind of move out of the institution and, kind of move into the EdTech space. For me, that decision was largely around impact, meaning, I was grateful for the impact that I could make at that one particular institution. But then moving into the EdTech world gave me an opportunity to impact hundreds of institutions at a given time. So that was really the draw. And then it was, also an opportunity just to exercise. I felt like some of my strengths on the business side. Yeah. So that's kind of been the second chapter of my career. Both have been great. I think I probably needed to start off on a campus to really understand the markets. And I think it's made me a better business leader having
Yeah.
started, in the shoes that our clients are in.
Yeah. So talk us through a little bit about some of the ventures, some of the organizations you've been a part of and how they've kind of scaled and managed kind of transactions and things like that. Like, walk us through a little bit some of your journey there.
Yeah, fortunately, I've had an opportunity to be in the fundraising side of higher education, also in the marketing, enrollment management, now more on the financial operations side of things. So I've been through kind of both sides of the M&A process. I've been through a couple of successful exits, and at the same time, I've been heavily involved or have led, I think, now 6 acquisitions during that time. So I've kind of been on both sides of the equation when it comes to M&A activity.
Yeah. I'm always curious. People that have been on both sides, right? Like, I think there's an appreciation of what the other side is going through, having been on that side of the table.
Yeah.
What are some, I guess, lessons you've learned in terms of how to approach, the M&A process? In terms of kind of philosophy or principles that you keep in mind when you're looking at a transaction? Anything that particularly sticks out in mind for you?
Yeah, I think, I think at a high level, I think, ultimately evaluating a company is kind of a triple combination of, really understanding the financial drivers,
Okay.
the customer drivers, and then finally the growth drivers.
Okay. So let's get into each one of those, because I'd love to really understand what you mean by that. So financial drivers, are you talking, just revenue, EBITDA, capital use, debt coverage, all those kind of things? Like, are there particular ones that you look at when you're looking at either selling or acquiring?
Yeah, I think the financial drivers that you rattle off, I think that's where all of our minds go first. That's the obvious one. What are the historical revenue trends, adjusted EBITDA, gross margins? And so that's what we all think about.
Mm-hmm.
I think the second one often is maybe overlooked or underestimated, which is customer drivers.
Okay.
So, as I think about our business, my company today, as I think about acquisitions that I've been a part of, looking at the customer drivers, like, are there certain segments of the market that are driving their growth? Are there other segments that are declining? Customer concentration. If 50 to 60% of the revenue is coming from just 2 or 3 clients, that could be problematic. So those are some examples of what I'm referring to with the customer drivers.
Are there cases, I'm curious about this one, because this is something I look at when we kind of look at strategy, is either on the sell side, or if we're selling, it's where do we have a particularly good story in terms of a segment that is growing, either in terms of size or in terms of profitability, and trying to make a disproportionate or a case for a disproportionate valuation because of some underlying trend, something that we could show is going to have a future growth potential. And on the flip side is, looking at from an acquisition point of view, both on the risk side of saying, okay, where do we have concentration that might be a risk, but also where do we have potentially unrealized opportunity, particularly if I've got a product or service that I can sell into this client base and sort of see insights. Like, how do you kind of approach the analysis of that kind of customer aspect, not only from a risk, but from an opportunity point of view?
Yeah, exactly. The customer drivers can cut both ways. You're hopefully looking at great client retention, both with dollars and logo counts, but you're also looking to identify where are there segments of the market that are untapped that this company has the potential to really break into. So I think it could run both ways, and I like the word risk that you brought up, because I think no matter what side of the transaction you're on, this is both about opportunity and it's also about risk mitigation. And those two go hand in hand.
Any good examples or strategies you've used for how to actually collect that data? Because I always find it's like, okay, like we can look at financial reports, we can look at, the kind of data that the company provides or the company has. But is there anything about, how to actually test this or talk to customers? Like, what have you done to validate or, just kind of verify some of this stuff?
Yeah. maybe two things come to mind. First of all, for my own self, as well as opportunities I've had to coach, teach, advise companies, think about those metrics from day one. Otherwise the due diligence process just becomes almost overbearing at the end. So thinking about these metrics from the very beginning, I mean, there's almost never too early of a time to start thinking about this.
Yeah. Are these things like CSAT scores and stuff, or are you
CSAT? Yeah, but I would maybe, I think one of the ways my thinking has evolved, I would say over the last decade, is focusing a lot more on what are the leading indicators in the business and putting almost hyper focus on that.
Yeah.
So the way my thinking has evolved, Bruce, is, I would say 10 years ago, companies I ran, companies I was looking to acquire, I was really focused on historical metrics.
Okay.
Which, I mean, that's where our mind all goes to.
Yeah.
That's pretty natural. Today, my thinking's a lot different. I spend much more of my focus on what are the leading indicators to the business.
Okay.
And, that can take some grinded out work to really figure out for each particular company, what are the leading indicators?
Yeah.
But once you have a handle on that, the narrative really begins to speak. And it's really, really, really eye-opening. So, just one quick example, and I'll just use Financial Aid Services, the current company I'm at. As a consulting firm, margins are important to us, just like any other company. We actually don't talk very much about margin at all. Okay. What we talk about is utilization. Because we have figured out our utilization rate, meaning on any given day, any given week, how many of our consultants are working for clients. Yeah. We know if that utilization rate is above a certain threshold, it's going to naturally lead to good margins.
Got it. So regardless of I guess having run consulting for a long time, I have lots of questions here. Yeah. Like, how do you distinguish between kind of raw utilization versus kind of profit contribution, kind of utilization, right? I mean, there's lots of ways I find in consulting or in kind of labor kind of management or labor tracking to kind of juice numbers to look like I'm really busy, but it might not be actually generating value. Like, how do you kind of tease apart that?
Yeah, well, that one example for us, utilization is the end all be all. For another company, they may look at profit contribution or they may put a little bit different twist. So that's where I meant by, I do think it's important to really kind of grind it out and figure out for each particular business, what are those 10 to 15 leading indicators that really tell the story.
Yeah.
Because I think, Bruce, leading indicators also reflect behavior. It'll tell you where gaps exist in the organization or where mindsets need to change or where talent is needed or a new tools kit is needed. That's where the leading indicators really come to life. So, another little bit more elementary example would be on the sales side. Here at our company, we don't really get too enamored on how many deals we closed on a particular week or a particular month or a particular quarter. What we're hyper-focused on is how many meetings, how many proposals are being sent out on a week-to-week basis, because we've run the numbers and figured out if we could hit those particular leading indicators, the deal closings naturally happen.
Yeah.
So that's how my thinking has evolved over the last decade, and leaning into that, I've seen has been really successful to me. So it's certainly kind of a Robert point of view.
Yeah.
To this particular discussion. And when I'm even on the transaction side of looking to acquire a company, I'm trying to look past just all those historical metrics, and I'm really trying to see if I can get with the company leaders to understand what are their leading indicators, because that's going to tell me the real story.
Yeah. Yeah. It's kind of, and I'm going to butcher this, I'm sure, but kind of a Moneyball approach of, figuring out, okay, what is that one metric that people are not looking at that if I can really kind of measure performance of a player around might lead to in a new context, in a new environment, could lead to exceptional performance. And I think that's very much about kind of figuring out those leadings rather than kind of focusing on trailing indicators. I guess, how do you balance some of these? Because I always find with KPIs and doing dashboards and things like that, there's this, yes, we have this leading metric or critical number or kind of something that we're really focused on to drive results, but because there's a risk of gamifying it a little bit, kind of balancing it with some other things that just kind of check it, like the whole, like, okay, how many meetings do we have? Well, I can set up meetings with all sorts of people, but are they qualified prospects or not? Like, how do you balance this out so that you don't get gamification of these?
Yeah, I like your word for it, balance. I mean, we literally call it a balanced scorecard. So it's a series of quantitative metrics, but also qualitative metrics, like a CSAT or an NPS score from our employees. So we'll do internal eNPS scoring with our employees. We're doing NPS scores and client satisfaction with our clients. So I think the key word you mentioned it is balance, and it's being able to balance both the quantitative and the qualitative to where you get a good balanced 360-degree view of what's driving the company and maybe, or better said, what's really creating value inside the company, value for clients as well as value for shareholders.
Yeah. So in terms of transactions, was your first experience on the selling or on buying?
First experience was on the exit side.
Okay. So tell me a little bit about that. Like, what did you learn, or I guess what was it like going into that? And then what did you learn during that process of actually doing a deal? I always find the first time someone goes through a deal, there's lots of like ahas and, oh, I never realized that, or, being in it is very different than watching it from the sidelines.
Yeah, absolutely. And I was a member of an executive team. There was kind of a core small group of us going through that process. What I remember most about it was the due diligence overload. No matter how much people told me to prepare, until you go through it the first time, there's almost nothing that prepares you for it. So that's what actually sticks out the most in my mind. And it wasn't just the amount of data and the activity and the work that goes behind it. I think what I had to get used to was the scrutiny that goes into that part of the process. You feel like you're on the hot seat, you're fielding questions left and right, and sometimes it feels like there's a tone of critique coming at this.
Absolutely.
And so there was a tremendous amount of workload, but it was also having to get used to, hey, this is not personal. And there really is no critique. These are buyers that are really trying to get to the heart of what's driving this company, what's creating value for clients and for employees and for shareholders. And, they have to ask a lot of tough questions. They have to really probe to be able to get that.
Yeah.
So that's what stands out to me the most, both the workload, but also just kind of the scrutiny that went into that process.
Yeah, I always joke it's like getting a colonoscopy and a root canal at the same time.
A little bit, yeah.
Yeah. Was there any kind of scrutiny or questions they were asking or data they were looking for that was either surprising or you didn't quite understand what they were going to do with the data? I sometimes find that on the sell side, people don't quite get, like, okay, why are they asking for this information? Or they're surprised by something that a buyer is looking for.
Yeah, I think that's where what probably sparked my thinking around the leading indicators. I think I went into it much more focused on just those general historic metrics that we were tracking. Yeah. I knew inside and out. And, at least that in that first experience, it was less about that. And it was a lot more about these leading indicators that I was talking about that I hadn't thought nearly as much about. Yeah. And so that probably is, I think, back on your question, that was probably the genesis of where I started shifting my thinking to go, okay, running, not just buying and selling businesses, but really creating value inside of a business is really about these leading indicators. So I've gotten much sharper at that, whether it's an M&A activity or it's just, leading the company that I lead today.
Yeah, yeah. So let's flip it on the other side in terms of being on the buyer. Tell us a little bit about how you've approached the acquisition side, both in terms of strategy, seeing where acquisitions was going to help you from a business point of view, either kind of strategically or financially, and then how you kind of went to market. Like, how did you go about looking at the market for opportunities, evaluating opportunities, and doing deals?
Yeah, I guess there's multiple philosophies to this. So I'm not saying this is the one way to do it. I just think I bring a particular perspective to this that maybe your listeners and audience find some value to. So to me, I know one philosophy is sometimes you can use M&A to just purely grab market share.
Yeah.
I've not really gone that direction. I've looked at M&A activity as ways to complement or to expand into new segments or something that really aligns more with our strategic plan. So, for example, if our strategic plan has 4 or 5 major swim lanes, I'm looking at what we can do organically in each one of those swim lanes, to advance that differentiator. But I'm also looking at, are there acquisition targets in each of those swim lanes that could really accelerate this or strengthen it beyond, what our goals were originally calling for.
Yeah.
So that's the way I've typically viewed it is, obviously, you want to look at the financials and how all that would work, but I'm looking at how could a potential acquisition really strengthen, advance, or accelerate one of the major strategic pillars in our strategic plan.
Yeah. And how, I guess, are there any strategies you use for kind of managing benefit versus risk on some of those things? Like, doing an acquisition kind of gets you immediate capacity or capabilities or access to markets or, customers. But, there's risks associated with this in terms of, obviously the nature, just general risks of doing a deal, but also cultural fit, integration, post-transaction stuff. Any thoughts on how you've kind of managed that or kind of evaluated that when you look at an acquisition opportunity and kind of figured out, okay, is this going to be worth the transaction or not?
Yeah, great point. I think one of the very early acquisitions that I was a part of, admittedly, we as the acquiring company probably underestimated the integration aspect of this. And so that was a lesson learned of, all right, I am not going to make that mistake again. So now, I'm thinking about potential integration from some of the early exploratory conversations, not because I'm trying to jump the gun or get way too ahead, but just as your question alluded to, the culture fit of the organizations, either the opportunities or the difficulties of integrating the two cultures or the two different organizations. I've seen and experienced can derail an acquisition in no time at all. So the finances can look incredible on paper. Mm-hmm. The market could look super attractive of these two companies joining forces. But if the culture and the integration plan isn't going to work, then I'm willing to walk away from those kind of opportunities because culture and integration is absolutely at the heart of making this work.
Yeah. Yeah, I think I have yet to talk to somebody that said the integration was a lot easier than they thought it would be. Yeah. Like it's usually the errors on the other side. You mentioned culture. Like I know this is it's kind of a, I guess, nebulous one sometimes, but is there anything that you, any kind of questions or mindset or kind of things you're looking at inside the other organization and your own organization to kind of assess that cultural fit? Or at least give you some indicators on what the cultural complexities might be?
Yeah, mission, vision, core values. I don't know if there's like a balanced scorecard I can point to on that. Their clients often tell that story. Yeah. You can usually get a pretty good feel for mission, vision, and core values through the course of the process. But to me, their clients really tell that story. Or, for me today at Financial Aid Services, if you really want to understand our mission, culture, and values, I always tell people, talk to our clients. They'll tell you the real story of it. So for me, that's always kind of been the best way, I guess, Bruce, to get to the heart of it is clients tend to tell that story really well.
I like that. And how one of the problems I always find or challenges I find with this process is everything is usually pretty quiet, right? You're doing a lot of this stuff with minimal exposure, right? You don't know if the deal's going to happen. You don't want to publish this to market, right? You don't actually want your full client base to know, right? There may be conflicts. A lot of times you don't want your employees to know, right? It can be really difficult with the secrecy. I always say it's like dating someone through a one-way mirror. It's like, okay, like I'm kind of observing from the outside. It seems like it might be a good fit, but you're getting married, right? And how are there any ways, either as the buyer or the seller, that you've found that you kind of make those decisions, or you kind of, I guess, balance that a little bit in terms of being able to provide some amount of insight and access without creating a situation where if the deal doesn't happen, I'm going to be at a real disadvantage, or I'm going to have too much information in the market, or I'm going to put myself, make myself too vulnerable.
Yeah, no, great point. I mean, that is certainly one of the biggest challenges. It's a very, very small group under strict confidentiality that are having to navigate the situation. And then let's assume in your question that the deal does go through, then you've got employee bases at multiple companies that all of a sudden are going through a rapid amount of change, that they weren't expecting it at all. So I think what I've learned through a little bit of trial and error, maybe this comes back a little bit to the integration conversation that we were talking about, is, as the deal begins to look favorable, and you're getting into those later stages, I have found that it's worth time. Maybe if it's one or two people on the team starting to break away and think about the integration. Yeah. So that on day one, there is a nice playbook written out of, how we're managing the first day, how we're going to manage the first week, how we're going to manage the first 30 days, 60 days, 90 days, little things like, what email address are people going to have? Are they keeping their own legacy email address, or are we moving them all to a new email address? Benefits. Are they staying on their old benefits, or are we merging that? Like, the more of that can be figured out in advance on day one, when you roll it out, I have found makes the change much easier for the employees that are now directly impacted by all of this. Yeah. So it's a delicate point of trying to find that point to where things are looking promising and favorable, to where it's worth the time to start breaking out and thinking about this and working on that and developing those playbooks for the early weeks and months, but knowing that, until the signatures are on the paper, this thing's not finalized.
Yeah, till money's in the bank.
Yeah.
I've seen signatures happen and money not happen.
That's right. There. Yeah.
And I think it's a really good point, and it's something I realize that I talk to a lot of founders, or where we're going through transactions, is, these decisions are really important, right? Are you going to use one email address, or are you going to keep on the other email address? And what I tell people is, at some level, I don't care which one you do, but you got to do one, because the worst thing is being indecisive, right? Like, exactly. Post-transaction, if you're an employee is unaware of this transaction, all of a sudden you get this news, like, the worst thing in the world is to feel like leadership doesn't have a plan.
Exactly.
and like I said, like, pick one, pick the other, but just don't be indecisive, because that is really what scares employees. And that's when you start getting people like looking for jobs, and you get customers like uncertain, right? They start looking for other suppliers. Yeah. So having that plan and being committed to that plan and communicating that plan effectively is key for that post-transaction integration.
And I don't know what you've seen, Bruce, but from my experience, sometimes those first 30 days are really critical to a successful integration. So I love the way you put it. Even if it's not the perfect plan, just having a plan gives you a much bigger statistical advantage that those first 30 days are going to go smoother. That you're going to be able to capture the synergies and the enthusiasm. And if you could really capitalize that on the early weeks of the integration, it really sets the new company up, I think, for a nice runway of success. So I love how you put it. Even if it's not a perfect plan, just have a plan, because it'll make a world of difference.
Yeah, it really does. So let's talk a little bit about your situation now, and how you got involved in the company and what your goals are at this point. I mean, I know there was a history with the company, and I'm just kind of curious how you got involved and how it's kind of affected, or how your experience on the transaction side has kind of led to what you're doing today and where your focus is.
Financial Aid Services is a consulting and tech firm for higher education. So we specifically work with colleges and universities around their financial aid operations. Mm-hmm. And our clients are really trying to solve usually one or all of these four challenges. They're trying to use their financial operations to grow their enrollment, mm-hmm. which is how they make money as an organization. Secondly, they're trying to reduce their cost structures. And that's the best way to make college more affordable for students is to control costs. Third, they're trying to create a much better student experience. Mm-hmm. And then fourth, they're trying to mitigate risk. So your audience may or may not know, higher education is heavily regulated by the Department of Education. Yep. There's literally a financial aid manual that if you were to print out in hard copy form, it's 1,003 pages.
It's like the tax code.
It reads exactly like a tax code, and it's constantly changing.
Yeah, exactly.
And so we understand that system really, really well. So we do work with a lot of campuses because the financial environment and climate that they have to navigate is heavily regulated by the feds. So all of our clients are trying to solve one of those four problems, and ultimately all of our services help them make college more affordable, more accessible to more students than ever before. I'm not the founder of the company. Back in 1991, the company was founded around the dining room table of David and Gay Gray. David Gray was a really respected higher education administrator who thought there's got to be a better way of doing some of this. Yeah. And he was right. And he built a terrific company. His vision, his dream was to have just a small boutique consulting firm. Uh-huh. And so as he was ready to retire, after about 30 years of this being a founder-led company, he sold to private equity. Mm-hmm. And that's where I came into the picture, kind of as the professional CEO to kind of modernize the business and put it on the growth trajectory that private equity envisioned.
Yeah.
So that's.
Now, were you involved during the transaction or post-transaction?
This was all post-transaction. Okay. So I was at another really large EdTech firm at the time. My name came up in some conversations and things kind of took off from there. So I am probably more of what thought leaders like a Reid Hoffman or Satya Nadella would call more of like a refounder. Mm-hmm. I inherited a terrific company that had a lot of strengths, but it needed a refresh. Yeah, we needed to refresh strategy and culture. Mission, really just to be more responsive to the higher education market of today and where higher education is going over the next decade. So that's really helped kickstart kind of this new chapter, this new growth trajectory for the company. So fortunate that the team's been able to double the company in a very short amount of time. Earnings have even accelerated beyond that. And I'm really glad the team has no intention of that growth trajectory slowing down at all. So we're looking forward to what the next several years could bring.
Yeah. I mean, I think there's always, interesting for folks, particularly founders who sell and kind of get involved in private equity. And, it's a different game then, right? Like you've got money involved. People are investing equity and debt into things to, see growth and see some kind of exit. I guess how do you manage the kind of, I want to grow and scale and have more impact as a company, but I also need to be thinking through some kind of time horizons and, working with private equity to realize their goals. Like, I guess, how do you balance that relationship a little bit?
I kind of think about this, three-legged stool, so to speak, that's always got a little bit of wobbleness to it because you're, at least for me in my role, I'm constantly thinking about, first of all, what's best for our clients. Mm-hmm. Secondly, what's best for our team members and our employees. And then third, what's best for our shareholders. Mm-hmm. And it's not necessarily in that stank rake order. All three of those are the major constituents that I'm thinking about all the time. Mm-hmm. If I made decisions for just one of those groups, would be if I did everything our clients wanted us to do, we'd go out of business.
Yeah.
If I did everything,
all my services for free.
Yeah. If I did everything our private equity firm wanted to do, we'd be out of business. So it's a matter of finding a balance between all three of those stakeholders.
Yeah.
For me, I have found success there. And it may not be that there's solutions that are just a perfect win for all three. It's a balance.
Yeah. So
sometimes this is really, really great for our clients, and it's just good for our private equity partner sponsors. So I'm just trying to always find the balance between those three and constantly focus on value creation. I really feel like if we can just focus on creating value for our clients, usually really good things happen for all the other stakeholders.
Yeah, I generally find that, if things get confusing and complicated, at the end of the day, like, okay, where do we create value? And I always kind of joke, it's like, okay, we need to make money now and in the future, right? So it's going to be, there's a little bit of balance there. But if I can focus on value, right, at the end, everyone kind of wins if we're creating value. Now, it might be a longer term win or a shorter term win at different times, but I think that's a great kind of rubric to kind of make some of these decisions.
It's just amazing how easy it can be to get distracted from that. Just the day to day. So it sounds so simple, but just staying hyper focused on value creation makes a world of difference.
Yeah. Any kind of personal practices you have around keeping that in mind? I mean, do you have any mantras? Are you meditating every morning? Do you have a sign on the wall? Like what, any kind of tools that you use to just kind of keep that in mind as you're kind of in the complexities of day to day?
Yeah. I don't know about mantras, no signs on the wall. I think the best tool, a little bit more kind of on a corporate level, has just been our strategic planning process.
Yeah.
We have a strategic plan that's really aligned to an exit strategy when the timing's right. Now, that's always a rolling 3-year strategic plan. So we chose to go down the Metronomics route. I know you're familiar with that, Bruce.
Oh, yeah.
So, we have a three-year highly achievable goal that's always rotating. So that is what I think keeps us focused as a team and as an organization, is the alignment. And that has been a great vehicle for bringing together those three stakeholders: our financial sponsors, our clients, our internal constituents and team members. The strategic plan, I think, drives us towards finding the balance between those three. And then, since it is a rolling 3-year plan, it leaves that timing door open to where whenever the timing is right for a liquidity event, we know our strategic plan is going to be, pointed in that direction.
Yeah. As a strategic coach, I can't plus one that enough in terms of having that process. I had a post on LinkedIn recently about how I don't do annual planning anymore. Right? It's always once a year we do 3-year planning, just so you always have that kind of runway. Because I find that a lot of companies end up, you end up in that kind of December limbo. It's like I don't know what I'm doing in January because I haven't done my annual planning, so I always want that. So that was great. And we're going to hit time here. Robert, this has been a pleasure. Great stories, great insights. If people want to get more information about you or have questions, what's the best way to get a hold of you?
Yeah, probably the two best ways. You can hit my website at robert-heil.com, or you can find me on LinkedIn. Those are probably the two best places to connect with me.
Perfect. I'll make sure that those are in the show notes. Robert, thank you for taking the time today. It's been a pleasure.
All right. I appreciate it, Bruce. Great conversation.